Hello and welcome to Trading Hour. I'm Reema Tendulkar. With me is Vivek Iyer, and with the rally, the outperformance seen in the mid-cap index today, the mid-cap index has turned positive on a week-to-date basis. So till yesterday, the mid-cap index was still down, given the gashes that we had in the early part of the week. But now with this 1.5% up move, the mid-cap index is now positive for the week so far, though the small-cap index is still down close to about 0.9% if you do a tally of the first these 5 days. The benchmark indices are holding up pretty well. The Nifty is well above 23,400. We had a gap up opening, but through the first 2 hours of trade, we've managed to build on that. The Sensex is higher by close to about 500 points now. The only disappointing bit is banks not performing. So ICICI Bank is dragging the overall banking index, so that's a bit flat. But outside of that, consumption names are higher, so Trent is doing well. PSUs are up and about like BEL. You've got infrastructure names like L&T on the back of strong order inflows. That's higher. Auto names are participating on the way up, so it's fine. It's just on the way down. You've got an ICICI Bank Bharti, which is struggling a bit.
That's actually kind of recovered. The Bank Nifty now near the flat line. It was a significant underperformance at the start of the session. Well, a couple of stocks. The first one that you mentioned was Larsen. Very strong order inflow momentum, and that's actually aided the stock to rally, despite the fact that the core margins remain significantly weaker than expected. The specialty chemical stocks today are doing very well. Navin Fluorine, yesterday moved up almost 4.5% higher. Strong commentary, strong results, lot of EPS upgrades, and that stock is up over 8% today. On the other hand, what the street didn't like were the results of JSPL. Results were slightly muted. Additional capex that the company announced, something that the street didn't like. Bharat Electronics, like you mentioned, some follow-up buying. And on the other hand, one more stock, from the Bank Nifty that's actually dragged lower today is Bank of Baroda. Slightly muted set of results. The management also trimmed its NIM guidance, and on the back of that, over 4% lower as far as Bank of Baroda is concerned. So a lot of individual hits and misses, and that is what is keeping, the street very, very active.
Indeed. Let's get to corporate interaction then. We've got the management of eClerx joining in on the discussion. They reported their numbers about 2 days back. The top line of the company has gone up by 13%. Margins are on the flatter side, but within the company's guidance of 24 to 28%. Srinivasan, the CFO of the company, is now with us on the show. Thank you very much for joining in. First, if you could talk about the top line and the way forward. Now, for the first 3 months, first 3 quarters, you've clocked in about an 11-12% kind of a top line growth. Is that the run rate for Q4? And is FY26 likely to be better than FY25?
Yeah, hi. Thanks, Reema. Thanks for having me on the show. I think sequentially, our revenue went up by about 1.8%. And as you rightly noted, about 13% year on year. That's pretty much in line with expectations. And we're happy to note that all 3 of our businesses have shown growth in the year. We do have quite a strong pipeline, so we are expecting that if there are no significant roll-offs or changes, then there should be growth in Q4 as well.
Okay, and Q4 growth should again be in low teens? Is that the run rate? And what about FY26?
FY26 is kind of hard to predict. The pipeline is good, as I mentioned. And what we are also seeing is a buildup of large deals. So when we had put up our strategy for the year, we wanted to focus on large deals, and we wanted to also focus on cross-selling work between our 3 businesses. And there's been a buildup of pipeline in both these areas. So we are unable to predict what the revenue growth for FY26 will be, but all indications are that, the early indications are positive.
How much better is your deal pipeline today compared to, say, 3 months ago or 6 months ago?
I think it's about 20% up from 3 or 6 months back, and nearly 40% up from over the previous quarter last year.
Okay, that's a positive to note, because considering the wins have also gone up, you've managed to replenish that in terms of your pipeline, and it's up 20 and 40% respectively quarter on quarter, year on year.
Mr. Srinivasan, the other thing which we want to ask you is, as far as Q4 is concerned, what is the guidance that you have in terms of new logo addition? You've also mentioned in the call that you're looking at significant cross-selling and upselling opportunities. So Q4 FY26, top 10 clients, can they grow?
We don't give specific guidance on new logos or on the growth of top 10, non-top 10 in advance. So I will not be able to answer that question. But broadly, we should be able to see a growth.
But your top 10 clients didn't grow. The strategic clients didn't grow in Q3 versus Q2. Any particular reason for that?
There are always a little bit of movement quarter on quarter. So if you look at in the first 2 quarters of this year, top 10 growth was very, very strong. Just the third quarter, there has been a flattish trend on the top 10, but these are sort of short-term outcomes. The long-term outlook remains positive.
But are there any particular clients of yours which are under stress, facing certain headwinds because of which they brought down their work?
No, not really. There was short-term work that we were doing for some of these clients, which ended in Q2, the full impact of which we felt in Q3.
What about the cable as well as the telecom industry vertical? There's been a little bit of softness there. When do you expect that to recover?
I think the industry has been under pressure for some years now as companies, as subscribers are tending to cut the cord, move to streaming services, and so on. However, in that space, our delivery has been excellent. So even though clients are under stress, we've been able to grow our footprint and we've demonstrated growth in that segment. So for us, the outcome has been positive.
Getting back to the deal pipeline and your focus on large deals, what percentage of your pipeline today is, what you would constitute a large deal? And how is the deal conversion into revenues now? Because there was a slow down in the industry. There were deals in the pipeline, but it was just not converting into actual numbers and revenues.
So we don't comment. I can't comment on the percentage of large deals in the pipeline. But to your second question, it seems that with the new year, the budgets have opened up and we are seeing some amount of traction and progress in conversion. So conversion seems to have turned positive, faster than what it was from the previous quarter.
Could you give us a sense of attrition levels currently? Also give us a sense of staff utilization rates. We understand that on a sequential basis, it fell close to 140 basis points. What's the reason for that?
So in Q1, we had a buildup of staff because we were anticipating a lot of work in Q2. And that's why the Q2 utilization is at an all-time, near all-time high. And then that has sort of normalized in Q3. On the attrition is about 18% or so, which is well within manageable levels.
Srinivasan, what about generative AI? Because you're saying that the company has done a lot of proof of concepts on generative AI, but potential monetization has not been seen. Why is that? And do you see that changing in this, say, calendar year 2025?
Yeah, so monetization has not happened because clients are taking a lot of time to think over what it means for them and how they want to actually deploy the AI, whether they want to do it in a private cloud, and that if that is the case, then it means a lot more cost for them, or whether they are comfortable having the data go out and do it on the public LLMs. Then that leads to some amount of your data being shared outside. And therefore, there is some amount of slowness in decision making that we are seeing from them, specifically on conversion of pilots to paid. Having said that, we have embedded Gen AI in all our productized services. So in our product data management tools, Gen AI is embedded. In our KYC compliance manager solution, Gen AI is embedded. So to that extent, we are using Gen AI in all the services that we are delivering to our clients.
Got that. And what would be the margin pulls and pushes in FY26? What are the tailwinds and headwinds as you see it looking ahead?
Yeah, so we've established a new center in Latin America. So there's going to be some facility costs. We've added 1,800 seats in our India delivery centers. So there's going to be housekeeping security costs. So we do expect there to be some pressure on margin in Q4 as well. But overall for the year, we should be well within our 24 to 28 band.
Understood that. Thank you so much for joining us, giving us a sense of how Q3 panned by and also sense of the deal pipeline as far as Q4 and FY26 is concerned. Well, moving on, time now for a short break. Saurabh Agarwal from EY India and MS Money from Deloitte India join us next to discuss their expectations from budget over indirect taxes. Welcome back to Trading Hour. Well, IRDAI has come up with new rules to prevent the burden of rising premium on health insurance for senior citizens. Yashil's here with more details.
Well, Vivek, IRDAI is talking about a problem that, is so frequently discussed. That is, the steep increase in health insurance premiums, instances of which the regulator has come across very often in the recent past. We've seen increases happening to the tune of 60, 70, 80% in health insurance premium, and that's exactly what the regulator wants to arrest at this point of time, at least for senior citizens. What the regulator has said is that insurance companies cannot increase health insurance premiums by more than 10% in 1 year for senior citizens. If there are situations, there are circumstances where an insurer wants to increase more than 10%, then it can only do so with a consultation and an approval from the insurance regulator, that is IRDAI. Apart from that, IRDAI approval will also be needed by insurers in case they want to withdraw any individual health insurance products for senior citizens, which means without the approval of the regulator, these individual products for senior citizens cannot be withdrawn. Finally, the regulator has also asked insurance companies to have a common set of hospitals empanelment with them for cashless facility, as well as negotiate package rates on the lines of PM Jan Arogya Yojana, which is expected to bring the treatment costs also down for policyholders.
Thank you very much for that. In fact, let's talk about the budget tomorrow and find out what the expectations are from the indirect taxes. We have with us Saurabh Agarwal, tax partner at EY India, and we also have MS Money, who is the partner of GST at Deloitte India. Gentlemen, thank you very much for joining in. If both of you could weigh in, and Saurabh, you could start with this. There has been a lot of clamor for safeguard duty for protecting the domestic industry. We've heard that from all the titans in the steel industry. So are you expecting any import duty revisions in areas like steel, green energy, equipment, life-saving drugs? Take us through the expectation on this front.
If you look at from a custom duty perspective, it has been a much talked about area wherein it is expected by the industry that there will be tariff revisions in some areas. I don't foresee that there will be a big thing which is coming. But what I expect from the government when they are looking at rationalization of customs duty is to ensure that, like they gave a boost to the manufacturing by way of bringing in PLI scheme in various sectors. In some of the sunrise sectors, as you are talking about, solar module manufacturing, electronic components, semiconductor, green hydrogen, electric vehicles, lithium-ion cells. It's important for the government to clearly lay down the path of customs duty. Long back in the Kelkar committee, they laid down the 5-year tariff structure. So one of the expectations which is coming from the industry is to lay down a path for 3 to 5 years, divided into what should be the duty for raw material, intermediary, and finished goods, and how over a period of time these duty rates will pan out so that it provides a requisite clarity to the various stakeholders so that they can set up and build capacities, private equity and bankers can fund them, and the foreign companies can agree on tech collaboration and joint ventures.
Mr. Money, come in on this point. Do you expect the finance minister to lay down the roadmap for the taxation, say for the next 3 or 5 years, which provides clarity and that impetus to domestic manufacturing? And if yes, drill it down on individual sectors and the numbers in terms of expectations this time of protection.
Look, there is certainly a need, as we keep talking about various plans for the future, to have a very clear roadmap, not only in respect of customs duty that Saurabh said, also in respect of GST. We need to look at both and have a roadmap, because we have to bear in mind that both customs duty and GST are transaction-specific taxes. And since these are indirect taxes, businesses have to factor in whatever taxes they end up paying into the price of the products that they sell. So the competitiveness, the profitability, the funding, the working capital, it all depends and flows from this. And therefore, there is a need for clearly a roadmap in respect of customs duty tariffs, in respect of customs duty reforms, and also in respect of the GST reforms that are expected. Because while GST is the mandate of the GST Council, and it is not the mandate only of the central government, from a directional perspective, what is the status in respect of rationalization of GST rates? How are we in respect of inclusion of fuel-related products in GST? Do we have some kind of a roadmap of 1 year, 2 year, 3 years for that? What is it that we are going to do to make input tax credits easier for businesses where they are literally struggling today, and there are a lot of disputes on input tax credits as well? It is essential to have a roadmap covering all these issues as part of the budget. Now, whether we will see a roadmap in respect of customs and whether we will see some kind of directional clarity on GST, I guess we need to wait for roughly 24 hours from now.
Okay. Mr. Agarwal, another important aspect that, markets will be looking forward to is that, do you think there could be any change in taxes as far as tobacco is concerned? Not only that, do you expect any tinkering in the excise duty in the oil and gas sector? So petrol, diesel, CNG, do you expect any changes over there?
So tobacco is one subject which has been much talked about in the past, and every time, before the GST came in, there used to see some tweaks in the tobacco part of this story. But I don't foresee that there will be much of the changes as far as tobacco is concerned. But of course, on the petroleum products, we can foresee some bit of changes on the excise duty side.
Mr. Mani, on GST, do you expect any GST exemption or any sort of relief on the life insurance premiums, particularly on that front in this budget?
See, the budget cannot announce an exemption on the GST premiums or any relief to senior citizens or anything in the budget, because that can be only announced by the GST Council. But this is something where the GST Council has been actively working with the business for quite some time. And therefore, from a direction perspective, when they talk of the measures taken for senior citizens, for example, or when they talk of the measures taken to increase the insurance penetration in India, it is quite possible that we'll see some direction being given in terms of which way the next wave of GST reforms are headed. That's what we'll be watching out in the budget tomorrow.
Mr. Agarwal, one question that we want to ask you is, as far as the solar value chain is concerned or green energy is concerned, there are multiple duties that have come in which have actually protected the domestic market. Along with that, there are also certain laws that indicate that there has to be a certain component of domestic manufacturing that has to be used in this particular development of green energy. Do you expect any tinkering of taxes? Do you expect some more SOPs to be given as far as the entire green value chain is concerned?
So, if you look at from a solar module perspective, from in 22, the rate of duty got changed to 40% as a basic customs duty, and on cell it got changed to around 25%. Duty rates are already quite high when it comes to module and cell. The wafer production as of now is not there in India. I do expect that government should clearly lay down that when do they plan to levy tariff duty or a tariff barrier as far as wafers are concerned, which will give a clear plan to the industry as to by when they need to set up the wafer and ingots manufacturing in India. So that's something which is very important. The other thing I think which is very important is around the entire story around SEZ as far as the green hydrogen is concerned, because a lot of green hydrogen players are planning to set up a unit in SEZ in order to bring down their capex cost. And there are some bit of clarities which are awaited. So maybe in this particular budget, if government gives some clarity to this particular industry, that will be really helpful for the industry to form up their plans.
Mr. Agarwal, what about the amnesty scheme for customs? There are so many cases which are pending. There is litigation going on. Is this a key ask of the industry, and how likely is it that it could be announced in the budget?
So I think last 2 to 3 years, it has been the ask of the industry. And again, if you see in the last budget, government has come out with the GST amnesty scheme, some sort of a GST amnesty. I may not call it as amnesty in particular. As far as customs is concerned, it has been quite long that government has not come up with the amnesty scheme. One of the reasons of the government not to come up with the amnesty scheme is because it is considered that amnesty schemes are not good for the bona fide taxpayers who have complied with the law time and again. But if we look at the long pending litigation which is there, it is clearly has been an ask of the industry for the last 2 to 3 years. And if you ask me at my personal level, I do expect an amnesty scheme for customs being rolled out as a part of this budget.
Mr. Mani, from the ease of doing business, what do you expect from the FM tomorrow in terms of the indirect taxation route? What are your key asks from her?
Look, in terms of ease of doing business, there has been a lot of work already done on the customs side in respect of making the import processes easier and quicker, in respect of making the export processes easier and quicker. A lot of work has happened already on customs in the past few years. But there is clearly much more that we need to do, because when we compare the import clearance time and export clearance time in India, compared with many of the other countries which are importers and exporters, we are far behind. So a lot of work needs to be done in respect of expediting the movement of both import cargo and export cargo. This is one area. The other area when it comes to GST is there is a lot of struggle even today in respect of the eligible input tax credits and the ineligible input tax credits. And we have to bear in mind that when we talk of input tax credits, it's not a tax term that is used, which some people use. An input tax credit is working capital for any organization. It could be a large player, it could be an SME or MSME as well. So when the input tax credits get blocked due to some reason, or they are not available due to some reason, people's ability to scale up their working capital suddenly comes into picture. And the business that was viable suddenly tends to become unviable just because they have money in their books which they are not able to utilize. So in respect of the input tax credit changes, how do blocked input tax credit get treated? What needs to be done in order to make it seamless for businesses? That was the promise of GST. I guess something on those lines would be very good. But as I said earlier, the remit of the GST Council is to look at GST. It is not part of the union budget. And therefore, from a directional perspective, we might get to hear that they are planning to make input tax credit easier and smoother for all businesses.
Indeed. Thank you very much, gentlemen, for joining in, and look forward to more conversations once the fine print, the budget is out and we get a chance to go through the fine print. Thank you for your inputs. We'll slip into a very short break. Before that, some stocks are slipping, even though at the headline level we're holding up well. Whirlpool is now down close to about 10%. Voltas continues to remain under pressure. The street was disappointed with the numbers. Voltas is down another 1.5%. And Credit Access Grameen has now dipped into the red. These are some stocks which have lost some momentum and steam in the last 30 minutes or so. Get into a break. On the other side, we'll discuss market technicals. Mitesh Thakkar joins in next. Welcome back. Let's talk about the market technicals. It's been a good Friday so far. Mitesh is back with us. Mitesh, you were saying that markets need to conquer levels of 23,300, 350 for that bullish momentum and bias to come through. Now that's happened, and quite convincingly, because we've been holding above 23,400. So what's the strategy now?
So, good morning. Beyond that, I was looking at a test of possibly 23,500. And looks like we'll possibly do that. And once we start getting past 23,500, 530 zone, good chance that we might actually make a dash to about 24,000 levels as well. So stay positive. Just trail your stop losses now to about 330 zones, and hope that this kind of up move, extends on the upside, which is what the charts are suggesting. So there's a good possibility of us continuing to head higher and test higher levels.
Mitesh, any individual stock calls for the day?
I have a buy on MLM. Keep a stop below levels of 29.80 here. Look for a target of around 31.30. And AV Capital is a buy with a stop at about 175.5 for targets of 180.
Thank you so much, Mitesh, for joining us, giving us a view on the markets as well as your individual stock picks. Well, moving on, it's now time for the Growth Code, a special initiative by Grow and CNBC-TV18 designed to provide you with valuable insights and strategies to navigate the market and make informed trading decisions. Today, we look at how the new SEBI guidelines on F&O trading are impacting the market, how traders are adapting to these rules and what lies ahead for you. Watch out to find out.
Derivatives trading has skyrocketed in India. F&O volumes have jumped from 4.6 lakh crore in 2018 to 138 lakh crore in 2024. While the number of active traders have grown eightfold to reach over 40 lakh.
Most of these new traders are under the age of 25. The risk-taking ability of this current generation is extremely high. They are lured into the markets because of quick profits, because of the hype in social media and ease of digital access.
To protect these investors, SEBI announced new guidelines for F&O trading. What has been the impact?
The volumes of retail traders have significantly gone down. Even the market's volatility has gone down since these rules have been implemented.
However, these rules have brought up a few challenges.
So because of increased margins and because of increased costs and increased charges, the profitability has definitely come down. A lot of small-time option writers would be forced into option buying where the odds of success are much lower. Let's say a new trader who wants to experiment in the markets. Previously, he would have come with a very small amount of capital and that was enough to experiment and dabble in the markets. But now because of increased margins, the same amount has gone up.
For individual F&O traders, adapting to this new era will be key.
Focus on risk management and focus on long-term sustainability rather than having like a quick buck in a quarter.
As the market adapts, these new rules can help create a more resilient ecosystem, offering traders better protection.
Welcome back to Trading Hour. Well, George Thomas from Quantum AMC joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much for joining us, George. First up, what are you making of the earnings season so far, especially given the fact that you've now had a couple of large capital goods companies like L&T go ahead and deliver their earnings? So how are you looking at that space particularly?
So from a capital goods perspective, from an earnings standpoint, it looks reasonably okay in terms of the order book growth or execution. If we look at it, it has been in line with expectations. So there is not much, nothing much from an earnings perspective. But the clear problem is with respect to valuations, where it remained elevated across most of the space. So even with the recent market correction, if we look at the broader market level, so at least if I consider the top 750 odd names, which has recent market caps, decent market caps, if I look at it, the correction has not been material enough for us to trigger a new addition. So if I look at almost 60% of the stocks have fallen by less than 30% from their recent highs. So considering the recent stellar rally, those have not been enough for us to make a new addition into any of those space.
George, on the whole, how has the earnings season been to your mind? What's the skew of upgrades, downgrades, and any firm trend that you've identified post the Q3 earnings, which you can incorporate it in your portfolio in terms of a strategy?
Clearly, there is some moderation in terms of consumption, and some part of it is due to high base. For sectors like real estate, where we have seen a stellar rally in the last 2-3 years, a lot of that earnings moderation is due to high base. So once we normalize, we don't see there is any clear thing to worry. But on so rather than speaking on a broad sectoral level, there has been selective opportunities. Like we have added some positions in some of the existing portfolio names into. So one of them is a rural-based two-wheeler company, and the other one is a gas transmission company where the demand visibility looks reasonably good, and they have a fairly good guaranteed return kind of model, where we feel the recent stock prices offer a decent amount of upside. But from a broader sector call, like I said initially, the valuations have not come off to a level where we could justify fresh additions which meets our threshold upside levels.
Understood that. And how are you looking at the banking and NBFC space? they've recovered quite significantly from the recent close after the RBI liquidity infusion that has come in. But post that, what exactly has transpired? Do you like any of these stocks?
Yes, so some of our recent additions have been into private sector banks. So clearly, if you look at it, the system liquidity is improving, and our sense is as those credit environment kind of normalizes, some of the better underwriters would stand out. And our sense is in the times to come, considering the levels at which they are currently trading, some of the private sector banks and large financials could lead the next leg of rally. Because considering that they are at fairly attractive levels and the environment is kind of normalizing. So even if you look at the broader macro perspective, even the private capex or even the infra development has not been at its best pace in the recent past. So as and when that normalization happened, we should see some ripple effect passing on to them. Plus, the credit environment is normalizing. All these would lead to some of the good underwriters standing out.
Understood that. And so within the BFSI space, what would be the order of preference? Or would you like private banks, PSU banks, or would you like the NBFCs? And within NBFCs, how would you rate vehicle financiers versus home financiers?
See, private sector banks is the obvious preference there for the reasons which I already stated. But within NBFCs, we have positions in certain select NBFCs which has good niche skills. One, it could be either a certain segment where they have good track record and ability to underwrite, where the masses may not have. Or it could be a cost of funding advantage because of better parentage and things. But some of the home financiers which have come up in the recent past, our sense is, their collection systems has little more room to streamline. And once, until that is verified, we would stay away from such names.
What about stocks like Zomato? Is it a buy at 220?
See, I don't want to give a stock-specific call, but obviously some of these new age business models where profitability has barely started showing up. So from a fundamental investor to justify these kind of valuations, you would have to factor cash flows far out into the future. And that is quite challenging. The valuation is a clear challenge there, where you would have to justify the current levels with cash flows which are far out in the future. And those are very sensitive to how a lot of assumptions move out. So some of the new age names where cash flows are kind of back-ended, we would currently stay away from them at these levels.
Understood that. Now, within the materials and mining space, how do you look at cement companies and how are you looking at the metal names?
See, both these sectors are at interesting juncture if you look at it. If you look at cement, the environment has not been great. The pricing environment has not been that conducive in the recent past. And our sense is from the kind of consolidation which the sector has gone through, it could be just a matter of time before the pricing power comes in. And at that point in time, we would see the profitability levels inching up, because clearly, if we look at certain regions, the current profitability levels does not justify any incremental investment, and therefore that itself would give a natural push to pricing over the medium term. And therefore, we are quite positive in some of those regional names. So coming to the metal names, globally, if you look at metals, the capacity additions have been quite minimal. And the largest economy, China, they have very clear goals in terms of emission standards and their targets in terms of capacities in various metals. So some of the key metals could see reasonable support from the basis that the incremental capacity additions is limited. And therefore, pricing support should be a lot higher than what we would see, we have seen in the past cycles. So from that perspective, some of the metal names looks interesting. But of course, upside has to increase slightly from the current levels.
Thank you so much, George, for joining us and giving us a sense of how you're looking at markets, your fundamental picks, and your sectoral views. Well, some time ago, you saw a few flashes on your screen. This is regarding, definition of geographical areas as far as city gas distribution companies are concerned, and they have now been notified as common carrier areas. This will have significant implications for the incumbent CGDs, so names like Gujarat Gas, Mahanagar Gas and IGL will remain in focus. We'll await more details on this particular development. But time now for a short break. Management of Welspun Living joins us next to discuss their Q3 numbers and more.
Welcome back. Let's invite the management of Welspun Living. Now, the company's top-line growth was fairly muted. Remember, this is a company which gets most of their revenues from textile and part of it from the flooring business. And the company's top-line growth this time was just 3.2% on a year-on-year basis. Margins contracted to 11.3%. And as a result of this, profits of the company were down close to about 30%. Dipali Goenka, MD and CEO of the company, is now with us on the show. Dipali, morning. This is Rima here. First, talk to us about the textile business. Revenues are muted, margins under pressure. What happened in the company? What happened in the quarter?
First of all, let me tell you, our top line is on track. Today, also 11.7% YTD is our top line. Our margins, there was a small blip for this quarter. It is also because of the margin mix, because of the currency, because rupee depreciated, and also because of the freight issues. And I think this is just going to be this quarter. And hence, we've given a target of around 14% EBITDA for this annual year, for the year annual. But top line on track, 15,000 crores as we committed on 2027. It is just a matter of this quarter. So I don't think so there's anything to really fret about anywhere.
So what would be, are you on track for your margin guidance, or do you think it's going to be lower?
As I spoke about, our margin guidance, we've given a 14% EBITDA margin instead of 15%. And that's the only deviation. And that's also been a matter of because the macro effects, in the, and we all know that, Yeah.
Understood that. Dipali, first of all, thank you so much for joining us. So as far as the top line is concerned, you've maintained the guidance that you've given. And for the EBITDA margin, you've slightly lowered it. Could you give us a sense of the capacity utilization trend as far as the new pillow facility is concerned? Because that is something that the street believes will drive revenues going forward. How was it in Q3? How do you expect that to revive in Q4 and expectations for FY26?
So pillows is something that we've invested in America. And right now it is at the capacity of around 24 to 30%. But going forward, we are looking at, and this year, end of this year, we'll be at a top line of around $20 million. And we'll be doubling it for the next year, around $45 million. The opportunity is that it is equivalent to the, the volume of towels in the United States of America. So that's where we see a great opportunity. And definitely made in America will be also a very interesting thing to see in the new regime as well. So yes, made in India for our home textiles, along with this mixed bag of make in America and also distributed in America through our warehouses is an interesting way forward.
Dipali, I understand that you're maintaining your revenue guidance, and if I look at the 9-month performance, you're on track, 11% kind of a top line growth. But particularly in the last 3 months, growth has slowed down compared to what it was in the first half of the year. So has anything in the demand environment changed, or from your clients' end, which explains that?
So let me tell you, when we talk about our home textile business, there's a way that, we work in. Half one has always been the highest quarters. Half one is the highest part of the year. And half two generally tends to slow down because quarter three is the end of the year for most of the retailers, where they have the stock correction and it is, the fag end of their, festival season. So they are correcting their inventories. So it's always been that the quarter three tends to slow down, and more so that you've seen right now, because it is actually also on a larger base. So that's where you've seen it, but we'll continue to grow on this larger base as well, where we are headed towards our numbers. And I think our guidance towards our top line is intact. EBITDA has just by a blip of 1%, I think definitely that's it.
Dipali, the other question is, you had earlier guided the street to a net debt of 14 to 1500 crore by the end of FY25. On a sequential basis, net debt has increased by close to 150 crore. Is there a one-off? Do you continue to retain the net debt reduction guidance? And we also believe that by FY28, you aspire to be debt-free. So is that on track?
Absolutely. And end of this year, we will be at 1,500 crores. It is a matter of working capital and, our CapEx. That's where you've seen this impact on the net debt. But we are on track for that as well in the Q4. And as we go forward, year 28, we are absolutely looking at net debt, zero.
What are the early indications of FY26? You would have heard from your clients on the kind of ordering for the coming year. So what can you guide your shareholders about FY26? How much better compared to FY25?
So we'll maintain a steady state growth of, 9 to 10% on a home textile business. Emerging businesses will continue to grow and contribute to over 30% to our top line. Domestic business will grow at a CAGR of around 30-35%. And we are waiting for the budget as well. I think that could be a great opportunity because, with the kind of higher disposable income that will come into, the consumers is going to be a great opportunity for India. The tax relief that people are talking about, I think is a very interesting thing that we are seeing. So overarchingly, maintaining a growth of home textile in the terms of 10%, CAGR of 30% in the emerging businesses is the way forward for what we are talking about.
Dipali, I want to understand from you on the flooring business. We understand that revenues from the B2B segment increased by close to 12% on a year-on-year basis. But sequentially, there's been quite a sharp dip, a little over 20% dip. So what actually happened over there, and how's the branded segment of the flooring business performing?
So India actually has grown and actually is getting on EBITDA positive for us. And let me tell you, I mean, it has grown by 10 to 12%. And when I talk about the global flooring, again, the freight and the Red Sea issues have been a kind of a slight aberration for this quarter. Yes, and I think, and that with the new administration coming in, that is going to be behind us. The freight costs are also coming down. So yeah, we will see a positive upside on that as well. And we're working with OEMs and the home improvements and the others as well, and the commercial and the institutional businesses there.
Dipali, how does the depreciating rupee impact you on the margin? Is it net positive?
It will be. I mean, if we plan for that, and it's just as we go forward, it definitely will be. And also, let me also give you a perspective. If I compare it to our peers, currencies are far more depreciating vis-a-vis us, and so hence they challenge us in the terms of being competitive, in the global, competitiveness in the terms of products. So I think definitely that's going to be an opportunity. India definitely is in the bright spot in the terms of the supply chain as well, where people are looking at India, where you have a stable supply chain of cotton, and also your vertical integrated plants and the skilling of your manpower definitely is going to be a very huge opportunity. And yes, in the budget, we also feel if we can get a good impetus for the MSMEs, it could give, because they are the bedrock of our home textile, that could be a great one for us to see.
Thank you, Dipali, for joining in. That's the word coming in from Welspun Living. Get into break. But here is some good news for all our viewers, because India's business news leader is now just a click away. So we're introducing the all-new app. So get instant access to breaking news, all our articles, financial world updates at your fingertips. Download the app now from the Apple Store or the Google Play Store, or you could just scan the QR code on your screen.
Welcome back to Trading Hour. Well, ahead of the budget tomorrow, there's a bit of rally, especially as far as auto stocks are concerned. Have a look at names like Ashok Leyland, that stock near the day's highest point. Have a look at Hero MotoCorp, up almost 4%. Some of the other names that are doing quite well, names like UPL, even the entire wires and cables pack today has recovered quite smartly. Have a look at names like Havells, have a look at Polycab, KEI Industries. All of these stocks today have recovered quite sharply from the recent lows. But with that, it's time to call an end to Trading Hour. Stay tuned. Halftime report is up next.